Unlike me, who got beat up at jiu-jitsu over the weekend.
For the record, your mom came on to me. Holy crap.
The markets have been performing extremely well so far this year. What's going on, guys? I'm Robert Montez with Nexus Wealth Management, and this is our 6-month forward-looking outlook on where we see the markets heading. Overall, we at Nexus are remaining genuinely optimistic about the year ahead. The economy continues to show real resilience with solid corporate earnings and AI investment powering productivity gains. As such, many analysts are speculating double-digit returns in the S&P this year, with volatility indexes remaining in calm territories and betting markets pricing recession odds extremely low for 2026. Conditions feel constructive, though some firms rightly point out that elevated valuations mean we need to stay realistic about potential gentle pullbacks. So here are a few of the positive drivers we're watching closely this week. First is broadening corporate profit strength. We're seeing gains which are spreading beyond the biggest tech names into industrials, value, and smaller companies. This helps build more stable returns from the broader economy versus just large tech-based mega corporations. Second, our expectations for continued Fed support. While we didn't see a rate cut in January, gradual cuts amid cooling but steady growth have kept borrowing costs manageable for businesses and households alike. And finally is the sustained AI infrastructure boom. Continued investments are starting to translate into broader productivity lifts that are supporting earnings across industries. And while people continue to ask me if we should be worried about another dot-com bubble with AI, my response is always a reminder to look at today's leading AI players compared to companies during the dot-com bubble. Today, companies like NVIDIA, Microsoft, Amazon, and Google are generating substantial revenue and profits, funding huge infrastructure from operating cash flows rather than speculative debt. In addition, enterprise adoption is widespread with tangible productivity tools delivering measurable impact across industries. This is completely unlike the dot-com era's overhyped promises of products that never materialize. Now, with that said, guys, nothing moves straight up. The challenge is we're keeping an eye on our potential pauses from sticky inflation pressures, which could be tariff related, any surprises in Fed policy direction, or if AI spending doesn't deliver quick enough payoffs in some sectors. Furthermore, with AI valuations remaining elevated, concentration is high, and heavy spending could trigger a 10 to 20% correction if return on investments lags or growth slows. However, it is worth noting that the consensus from Goldman Sachs, JP Morgan, Morgan Stanley, and others view AI as a structural transformation with real economic underpinnings and not pure speculation. However, it is worth noting that the consensus from Goldman Sachs, JP Morgan, Morgan Stanley, and others views AI as a structural transformation with real economic underpinnings, not pure speculation, making a full dot-com style burst unlikely. So guys, that's our outlook at Nexus, cautiously optimistic. Let me know what you think in the comments and feel free to reach out with any questions. Also, I'll be taking next week off as my wife and I visit Mexico, so I'll see you all in 2 weeks with a great tan. Thanks a lot.